Welcome to vTalkInsight, Market Drivers Daily for February 20th, 2026. Today, an aggressive wave of AI capital spending, rising oil and gold on Middle East tensions, and a still resilient growth backdrop are pulling rates, equities, and commodities in different directions. Let's unpack how those forces are colliding across portfolios. The AI story has moved from pure excitement to a hard capital cycle that is now visible across funding, credit, and trade flows. Massive infrastructure plans, from data centers to power and connectivity, are transforming AI into one of the dominant macro drivers of spending. That is forcing markets to reconsider where returns will actually accrue in this ecosystem and over what time horizon. In recent days, we have been tracking this shift from chip shortages toward questions about return on capital, and that theme is even clearer now. On the funding side, OpenAI is reportedly close to raising more than $100 billion, at valuations discussed as high as $850 billion, with backing from names like Microsoft, NVIDIA, Amazon, SoftBank, and others. At the same time, major technology firms are accelerating capital expenditure on AI infrastructure, with hyperscalers expected to spend over $500 billion in the coming months, and recent record Capex absorbing up to 92% of free cash flow in some cases. Credit markets are adjusting as well, with U.S. investment-grade tech issuance projected to climb to around $360 billion in 2026, largely to finance these build-outs, and banks like Morgan Stanley cutting trading fees in private share markets to capture demand in marquee names such as OpenAI. This capital wave is spilling directly into the real economy. Data center construction backlogs now provide visibility well into 2026 and early 2027, and one leading building materials group plans roughly $40 billion of growth investment by 2030 in core platforms like aggregates, cement, water, and roads. AI-driven Capex is also pulling through heavy demand for physical commodities, especially copper and other critical minerals, against a backdrop of underinvestment in resource supply since 2015. That combination of new demand and constrained supply is already supporting higher prices, stronger margins, and rising dividends for commodity producers. Even the U.S. trade deficit reflects this pivot, with the gap widening on strong imports of computers, accessories, and capital goods tied to AI-related data centers. Equity and credit markets are increasingly differentiating between winners and laggards inside the AI theme. Hardware and infrastructure names are seen as the most direct beneficiaries of this spending, while traditional software has faced sharp valuation resets and periods of tech-led drawdown, as investors reassess which business models are truly defensible against automation. There is also concern that AI disruption could damage credit quality in leveraged loans and private credit, particularly in software and business services, even as firms like Apollo push growth in higher-grade private credit and trading activity as a differentiator. For policymakers, AI is entering the rates debate. Some Fed officials are questioning whether AI-driven capital expenditure could lift the neutral rate and argue for keeping policy tighter, especially while short-term inflation pressures from higher electricity demand coexist with expectations of longer-term disinflation once the technology fully scales. All of this leaves a tension between the scale of the opportunity and the risks around valuation and timing. Wall Street caution is increasingly focused on heavy upfront Capex, uncertain monetization path for platforms like OpenAI ahead of any potential listing, and the fact that some tech giants are consuming the bulk of current free cash flow just to fund AI infrastructure. Software names have already seen sharp sell-offs, with some now argued to look attractive on resilient models and proprietary data, while market volatility in AI-exposed stocks is being amplified by fast retail flows that swing between hype and renewed focus on fundamentals. Key watch points now are AI-linked earnings across semiconductors, software, and user-facing platforms, as well as evidence in corporate results that internal productivity gains are starting to offset the capital drag. With that AI capital wave in mind, The other force markets are weighing today is an escalating geopolitical risk premium in energy. Geopolitics has snapped back to the foreground as tensions between the U.S. and Iran escalate. The U.S. military buildup in the Gulf is described as the largest regional presence in decades. Incredible reports of potential imminent action have pushed Brent crude above $70, with daily gains around 1 to 2%, and a geopolitical risk premium estimated at $7 to $10 a barrel. Regional benchmarks like Dubai crude are trading at a premium to Brent. European gas prices have jumped, and equity markets have turned risk off, with futures lower, volatility higher, and a visible rotation away from cyclicals. Baseline expectations still lean toward limited U.S. strikes rather than a full-scale conflict, in part because rising oil prices and cost of living concerns are constraining Washington's options, especially ahead of key political events such as the State of the Union and the midterm elections. At the same time, negotiations around Iran's nuclear program are moving, but slowly. Both sides are now discussing detailed inspection protocols, yet the International Atomic Energy Agency continues to stress that verifiable access to sites, including locations previously attacked, is non-negotiable. The timeline to reach a concrete agreement is tight, and uncertainty over future geopolitical alignments is complicating long-term corporate planning, feeding into boardroom risk assessments and deterring some investment. Europe, meanwhile, is often sidelined in U.S.-Russia and U.S.-Iran talks despite its latent economic and diplomatic weight, adding another layer of unpredictability to policy responses. For energy markets, the immediate effect is clear. Oil prices have seen their largest daily jump since October, and multiple updates highlight Brent and WTI, both up more than 1% as markets focus on the risk that Iranian retaliation could target energy infrastructure or even the Strait of Hormuz. Energy sector momentum is strong, with over 90% of constituents trading above their 200-day moving average, though that strength also leaves the complex vulnerable to consolidation if the spike proves short-lived. Case studies show the nuance beneath the surface. Air France-KLM, for example, reports resilient premium travel demand and has hedged more than 50 to 60% of its annual fuel spend, limiting short-term earnings sensitivity to oil spikes. Yet European airlines more broadly still face higher operational risk from restricted airspace over the Middle East, Russia, and Ukraine. There are also buffers on the supply side that could limit how long the shock lasts. The U.S. and Canada now export around 8 million barrels per day. Western producers have an incentive to hedge into rallies, and spare capacity from Saudi Arabia and other OPEC members is expected to mitigate even severe disruptions, according to several assessments. That is why a number of analysts still frame a sharp oil spike from a Middle East shock as more likely to be short-lived and concentrated in energy assets, rather than a repeat of the broad inflation spike seen earlier in the decade. Nonetheless, gold has surged above $5,000, supported by years of steady central bank buying to diversify away from dollar assets and by today's heightened political uncertainty, reinforcing its role as a portfolio hedge when geopolitical risk and Fed policy uncertainty coincide. The counter-argument is that persistent, unresolved tensions raise the odds of an event with more lasting impact than the typical 6-week recovery window often seen after past geopolitical shocks. Concerns include the possibility of miscalculation in a crowded Middle East theater, the strain on already weakened alliances if U.S. action is perceived as unilateral, and the risk that Iranian retaliation targets tankers or critical infrastructure in ways that test the assumed supply buffers. Markets are already reflecting some of this with a clear risk premium in oil options, firmer gold, and defensive sector outperformance, even as many participants still price only limited disruption. The key watch points now are any concrete U.S. or Iranian military moves, clarity around nuclear inspection access, and the resilience of Ukraine's energy grid heading into further talks. All of these factors feed directly into the global growth and inflation outlook, which is our next focus. The growth backdrop remains surprisingly firm, even as rate expectations edge higher again. Sticky core PCE inflation near 3%, alongside robust U.S. activity, is prompting markets to revisit the possibility that the Fed may need to keep policy restrictive for longer or even contemplate additional hikes, rather than the multiple cuts that were priced earlier. At the same time, earlier easing in financial conditions, strong corporate capital spending on AI and infrastructure, and upcoming consumer tax relief are all supporting a narrative of above-trend U.S. growth for the year. Incoming data and micro signals broadly reinforce that picture. Weekly jobless claims have surprised to the downside at 206,000 versus consensus around 225,000, pointing to ongoing labor market resilience. While Bank of America car data shows January spending up 2.6% year-on-year, with discretionary patterns similar to pre-pandemic norms. Non-residential construction jobs and investment are surging, underpinned by data center projects and broader infrastructure spending, and lower mortgage rates at a 3-year low are raising expectations for a rebound in new home sales. In freight, demand is still soft, but better readings from the ISM survey and continued home building, where each new home generates about 8 truckloads, suggest scope for a gradual volume recovery later this year. Importantly, growth is broadening beyond a narrow set of U.S. megacaps. In Europe, companies like Nestlé have raised guidance, projecting 3 to 4% sales growth and seeing their shares rally on restructuring and portfolio moves, while Deere and others in industrial signal that the agricultural earnings cycle may be bottoming, even if core segments remain under pressure. Travel and leisure remain resilient, with Booking Holdings delivering nearly $10 billion of adjusted EBITDA, returning over $8 billion to shareholders, and guiding for continued strong demand from higher-income consumers, and airlines such as Air France-KLM reporting solid transatlantic demand despite geopolitical noise. Financials and insurers are also participating. Zurich Insurance sees continued momentum in both property and casualty and life, and is investing heavily in AI talent as a growth driver rather than a cost-cutting tool, while emerging market equities are undergoing a structural re-rating on better governance, stronger macro fundamentals, and more diversified sector exposure. Europe's deep tech and climate tech ecosystems are gaining traction on the back of public initiatives and redirected U.S. capital, even though a shortage of growth-stage funding still risks pushing some winners to seek finance abroad. Against this constructive backdrop, several fault lines remain. The U.S. trade deficit is at its widest since the 1960s, driven by large gold exports and a surge in AI-related imports of computers and capital goods, highlighting external imbalances even as domestic demand looks strong. Growth is also uneven. Higher-income households continue to spend on travel and premium goods, while a K-shaped recovery and rising oil prices above $70 per barrel threaten affordability for lower-income consumers and keep cost-of-living politics in focus. Looking ahead, key watch points include U.S. data on PCE inflation, personal income and spending, GDP revisions, and consumer sentiment, as well as housing indicators that will show whether lower mortgage rates are feeding through. In Europe, decisions around fiscal support, especially in Germany, will help determine whether regional equities can build on re-rating through stronger earnings. And in emerging markets, the question is whether recent outperformance can be sustained if U.S. yields and the dollar remain firm. Together with the AI Capex cycle and geopolitical risk premium we discussed earlier, these growth dynamics will frame how cross-asset correlations evolve from here. Stepping back, 3 forces are defining the tape right now. The AI Capex wave is rewriting funding needs and boosting demand for chips, materials, and data center infrastructure, even as markets debate valuation and credit risks. Geopolitical tensions, particularly around Iran and the broader Middle East, are embedding a visible risk premium in oil and supporting gold, but with supply buffers that could still cap the duration of any spike. And the growth picture remains broadly resilient, led by U.S. demand and increasingly supported by Europe and emerging markets. Although higher for longer rate risks, external deficits, and unequal affordability are clear constraints. Putting those pieces together, Many portfolio teams are watching dispersion within the AI complex, scenario ranges for energy and safe havens, and whether upcoming data confirm an above-trend but policy-constrained global cycle. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.